Hi, and welcome to our Bare Bone Basics Foundations of Investing training. This is session 3, and I'm excited about the information we're going to share tonight. We're going to dive into one of my favorite areas of stocks, which is finding dividend income stocks. So let's take a look at what we're going to talk about. So tonight's agenda, we're going to talk about how to research stocks. We're going to try to find some simplified methods so that it's not overbearing. We're going to talk about some key metrics that I look for in stocks, and I'm going to share with you a tool that I use to kind of gauge whether I should buy or sell a stock, and it's very simple, and I'm also going to make that tool available for you. At the end of this session, you'll find a link that I'm going to post eventually in the comments here on the YouTube page that will take you to the actual tool. We're going to cover a dividend portfolio strategy. I'm actually going to show you some stocks. I'm going to show you a portfolio of 12 stocks and how it's set up so that every week of every month, a check is flowing in. So there's streams of income coming in. So we're going to actually walk through that. And then we're going to talk about some ways to how you can build your income, because it doesn't grow overnight. You're going to have to be patient and actually use the strategies that we have. But over time, if you can build $1, you can build 10. If you can build 10, you can build 100. If you can build 100, you can build 1,000. And from there, you get the picture. So I really want to focus on digging into how to get stocks and how to handle them once you get them. So let's get started. So how to research stocks. We went through this a little bit in session 2. And we want to expand where we were. There are several tools out there that you can use to research stocks. For example, if you were to type in stock screener into Google, there are tons, thousands of different types of stock screeners out there. And what a stock screener is it's just basically a query where you can type in specific things you're looking for. So let's say I'm looking for a stock that provides a dividend yield of at least 5%, and the cost of the stock is no more than $10 to $20. So the query is going to look for every stock that meets my requirements and then send me back a list. That's what a stock screener does. Those are pretty good to use if you're just looking for any and every name you can find. I do that maybe once every 2 or 3 months just to see if there's something out there. I can find some unheard of stocks that you don't hear about in the news, things that you don't hear about from your financial analysts that fall within my criteria, that every now and again I can find some pretty decent stocks that I could buy into. I stay away from always trying to buy the name brand. And what I mean by the name brand is the names of companies that you know. They're good to start, but you've heard me say this before, and I'm going to say it again. Amazon is great. Facebook is great. Apple is great. But if you're paying $1,000 for one share of a stock, you can do better with that $1,000 by buying into some cheaper stocks. You could do better from a dividend perspective. You can do better as far as a growth perspective. So keep that in mind. One of the ways to find stocks that you've never heard of, that you want to dig a little further into or find out more about, is to start with a stock screener. Like I said, you can find those everywhere. Just Google it and you can find it. You can work through your online broker. I use E-Trade, and E-Trade has its own scanner where I can type in what I'm looking for and it will kick back a list of stocks for me. You'll also find that your online broker may actually provide a list of recommended stocks that they have. Of course, you can always pay for research, where there are people out there who do this on a daily basis, night and day, nothing but studying the stock market for various types of investments. For us, we're focusing on income stocks, or what we call dividend stocks. And there are groups out there like Dividend.com that you could pay a yearly fee of about, I believe it's about $250. And they have different types of information that you can have access to. That's another way that you can find out what stock should I buy into. Institutional portfolio patterns. This is one of my favorite. We've talked in some of our earlier sessions about how institutions such as your mutual fund managers, how they're buying stocks for their portfolio. Their number one goal is to create income. If their number one goal is to create income and that's all they do night and day, then why not just piggyback off of what they're doing? Or at least start there. See who they're investing in, what's in the different portfolios. For those of you who are using things like, perfect example, there's an app called, we have Robinhood, and then there's another one that I have started to use called Stash. And in Stash, you can invest in small groups of stocks. Well, within the information they provide is a list of the top institutions who are also buying those same stocks. So you can actually find that information from your broker that you're using. You're going to have to dig a little bit. They're normally not just readily out there for you to see, but the information is public and you can find out who the top institutions are that are buying certain stocks. The other thing I look for when looking at institution portfolio patterns, the percentages. If I notice that a mutual fund company, let's say AXA Online, has over 10%, which is high, that's a lot for a institution to actually put money into as far as a stock, a particular investment stock. If I see that they're a major holder of a certain stock in their portfolio, I'm going to, that's an alert to me to open my eye and take a look at why. It must be producing very well. It could be that they bought into the company early and they earned income on it by growing from the growth of the stock. So they have capital gains or the worth of the stock has grown. It could be that it's an income producer like the ones that we're going to talk about today. So it actually gives you a starting point of where to go look. So how would I manage this? If I saw that a company or an institution has a certain stock that they have a pretty good amount of, 2 to 3% of their portfolio being on one particular stock is pretty good, I'll go and do some research on it. I'll pull up its ticker symbol. We talked about how to find a ticker symbol last week in session 2. And I'll just pull that up in my online broker and start finding out about the company. What do they do? How do they make money? Are they profitable? Do they owe a lot of money out? Long-term debt and short-term debt. What is their projected future? What are the financial analysts saying about them? I will do a little bit more of a deeper dive on companies that I'm not familiar with or in market areas that I'm not familiar with. I mentioned last week that I'm not very familiar with the health industry. So when it comes to pharmaceuticals, so before I invest in something that falls in the line of pharmaceuticals, my dive into that may be a little bit deeper than technology. Most of the ones who know me know that technology is what I do on a day-to-day basis as far as my day job. So something in the technical field, I might not have to dig as deep into. So whatever your specialization is in or your hobbies that you have, you won't have to dig as much to learn about that company as you would those that you know nothing about. So does that mean that you should never invest in anything that you don't know? Well, that's what Warren Buffett said. He said he doesn't invest in things he doesn't know. But times are changing. And in order to make sure that I am diversified across my portfolio, when I say diversified, meaning I'm not staying in one location. We're going to talk about diversification a little bit more shortly. Then I'm going to have to step out my comfort zone a little bit. And I may need to add a little bit, not my whole portfolio, maybe just a small portion in areas that I'm not comfortable with. But how do I manage that? I go find friends. There are tons of people on Facebook. Find a friend in the area that you're trying to learn about. If you're trying to invest in pharmaceuticals, find a pharmacist, befriend them, get to know them, ask questions about how, not so much about what they do that they can't share, but as far as in general, how the pharmaceutical market works, what makes it move, things to watch out for. And people are eager to talk, especially when it's something that is about themselves. It is human nature to want to talk about what you enjoy and what you know best. And you'll be surprised at how much information you can learn that way. Try talking to your pharmacist when you go to pick up a prescription one day and see how much how their eyes light up when you start talking about their field, something they know, they understand. They can't talk to you all day long, but you could get tips that way. So that's a good start there. Next is company financials. I mentioned about finding out how much debt a company has. All of this information, by the way, you can find from your online broker or by going to CNBC or Yahoo Finance or any one of these financial platforms online. And all of their company financials are going to be available. It's required by the SEC. Any company that is traded publicly has to submit their financials quarterly. And with that, you can find out a lot about a company. For example, if a company is not profiting any money, in other words, they're making a revenue, let's say their sales are $5 million, but their expenses are $6 million. That's $1 million in the hole. They're not going to pay out any dividends. Matter of fact, they're trying to figure out how to lay some people off. That's not a company I want. And that's easy information to see. If it's a company that you notice a pattern of a decline in their sales, their revenue, or a constant decline in their net profit meaning after the revenue they've made minus all their expenses that they had to pay out, what remains is their net profit. If their profit is declining year after year after year after year after year, red alert. That might be something I want to watch out for. And you can pull up the last 5 years, 1 year, 3 months, 6 months of data on a company's financials. And a quick look. I mean, you don't have to spend a lot of time looking at their financials. A quick look. If you see negative, 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 that's a sure sign to stay away. But if you see gradual growth, that's a good sign. Now, there are things that could be happening that could cause a company's financials to look a little off. For example, if they spent more money for the purpose of growth. So more money went into research and development, or more money went into real estate. So buying property to build more. Those are good expenses. Those are expenses that are used to grow a company. So if they're using their money wisely, it's going to create more income for that company, which means more income for you. Every single bit of that information is free information that you can Google about a company. It's required by the SEC to be available. As I mentioned, you can also get that. Oops, hit that button too soon. You can also get that from your online broker as well. Another method used, especially for those who are doing day trading or any type of short-term trading, is using charts. If you were looking for capital gains or growth of a stock and trying to cash in on a value stock or a stock that's low right now, and you want to see the trends of a particular company, you can use charting for that. There are several different types, but for the purpose of dividend stocks, you don't have to get into charting. That's a little bit more advanced. We're not going to cover that here. If you choose to get into charting, there are several free courses available on YouTube. Udemy has several courses that are pretty reasonably priced if you want to get into charting. But that's another method that's commonly used, is to follow the trend. If you see a stock trending downward, but over the course of the last 3 years, it reached its plateau as far as going down, and it is believed that it's going to trend back up, you may catch it at a certain point, at its low point, to buy it at value at a cheaper price so that you can trade it or sell it once it actually improves at a certain growth rate. So that's kind of what we would use charts for. As I mentioned, there are several different types of ways we can use different charts for the purpose of stocks. But for dividend income, you can take that off your plate. You don't have to worry about learning how to use charts for the purpose of doing income stocks. But I do want you to know that that's one of the methods that you can use to identify growth per se of stocks. Now, does this identify how much dividends you're going to get? Absolutely not. What could it do as far as watching charts? Well, the only way a company is going to pay a dividend is if they're making money. If they're not making money, they have no money to give you. So if the charts are constantly going downward, that might be an inclination. But like I said, I tend to stay away from charts when it comes to dividends, because the objective is to let your money do the work versus you spending hours upon hours upon hours doing the work. My goal, 1 hour a day of research, and that's for all my investments that I'm working on. I'm currently working on 8 different streams of income. And that's something else we're going to talk about in the future as well, how to find different streams of income. Right now, dividends are just one of them. So that's where our focus is today. Another option to research stocks is find out what the financial analysts are saying. Once again, every single online broker out there offers tools that you can use for free. One of those tools is access to what financial analysts are saying about stocks. Now, I personally have a love-hate relationship with financial analysts because it's their opinions. And depending on their purpose of looking at a stock, it could be different or counter my purpose of buying a stock. Okay, an example. Let's say there's a stock out there that pays a really good dividend, has a high dividend yield. It is a stable company that's doing pretty good. A financial analyst may say to sell, or better yet, not buy a stock because there's no potential growth. But if my purpose of buying the stock isn't for its growth, it's because it is stable and they're giving out money in the form of dividends, then their purpose of saying not to buy that stock and my purpose of buying it are not the same. So why would I use what financial analysts are saying? If they're saying to sell and everybody is saying to sell, you got it. That's a red alert for me. It at least tells me to go pay attention. Go take a look at why they're saying to sell. Did the CEO do something crazy and the stock is just plummeting? Did something happen in the market that's going to change that market? Is something new coming along that has disrupted that market? Okay, yes, everybody's going to say sell, and so am I. I'm going to sell. I'm going to go ahead and cash out on that one. There's no harm in that because you probably haven't lost anything as far as the value of the stock, but you gained on all the dividends that you received over time that you held the stock. So that's what I look for with financial analysts. I want to know their why. And if you pay attention to their why, it can kind of guide you in your thinking. Now, is this a requirement? Nope, not at all. Last but not least, my favorite. Last week, you heard me talk about follow the herd. The herd is what drives a stock. Watch the news. The news will tell you everything that's going on worldwide. If you know what shifts how a person thinks, then you know what will make them shift as far as their buying habits. If it came on the news today that Tylenol is being sued for $50 million because some horrific thing happened, Johnson & Johnson, or the makers of Tylenol, the value of their stock is going to drop, guaranteed. The next day, it's going to go down. The herd is going to start selling like crazy. I am going to go start buying like crazy. Why? They give dividends, and I'm able to buy at a discounted value because that company is strong enough to come back from something like that. I gave you my BP example last week when it came down to the oil. So watch the news. The news can kind of give you inclinations of what's going on with the herd because the herd is going to follow the news. I will also say watch social media. That is huge right now as far as where the herd is going. And for those who haven't seen session 2, when I mentioned the herd is the mass group of people. When everybody takes off, when a few people take off running, everybody starts taking off running. It's like a herd of animals running away from something. And if you know that the herd is going to go a particular direction, usually off of emotions or off of something that is temporal, then you can catch great deals on stocks and get them at a value. So these are the ways that I use to research stocks. Do you have to do all of these? Absolutely not. At a minimum, I would use a stock screener just to kind of get an idea of a good 20 stocks that I might want to look at. Out of 20, I might find 5 that I like. I use my online broker the most because a lot of the data is already there. How often do I do research? I research every night, but not everything. When I say every night, as I said, I have 8 streams of income that I'm working on. And I might work on one each day or something to that nature and leave my dividends to where my dividend stocks I might check once a quarter, every 90 days, because I buy stocks that are stable. A company that is giving out dividends, if it is a solid company, they're giving out dividends to reward people who own shares of their stock. There are companies, and here's a golden nugget. There are companies that will give dividends, a high dividend, just to keep people from selling their stocks. So let's say you find a company that's giving a dividend yield of 13%. That's pretty high. It could be that they increase their dividend yield or increase the amount they're giving out for a dividend to influence their holders not to sell their shares of stock. Because guess what happens? We talked about it. When the herd starts selling off their stocks, the stock price will drop. So a company might increase their increase the dividends that they're giving out as a method to incentivize shareholders to hold on to their stocks. So that's something to watch out for. And we're going to get into as far as how far is too far as far as a dividend yield, what's too high, what's too low, in just a moment. But those are things to watch out for as far as you're researching your stocks. Your main thing you're looking for with dividends, we're about to get in right now. Let's talk about it. Let's talk about the key metrics. Key metrics you're going to look for are dividend yield, payout ratio, cash payout ratio, total return, earnings per share or EPS, the price over earnings ratio. Those are our 6 key metrics. And from that, if you look for these for each stock that you're researching, you can come up with your own grading scale. Right now I have where if they have at least 5 of these key metrics are pretty good, then it's a strong buy. If they only have 4, then it's a buy, but with caution. Watch out, see what's going on. If it's just 3 key metrics are good, then if I already own them, I'm going to hold on to them. But if I don't own them yet, I'm going to hold off on buying them. If they only have 2 good key metrics, then I'm just going to hold if I have it, but keep my eye on them. I'll probably start researching them on a regular basis versus every 90 days if they're in the hold category or the hold with caution category. And the last one, if they only meet 1 of these metrics, then I'm going to either sell it or I'm just not going to buy it if I don't have it already. So what are these? Let's talk about each one individually. A dividend yield is the annualized dividend. When we say annualized, that means the total payout of dividends in a year per share. So if a company is giving out 25 cents per share per quarter, that's $1 per year annualized. So the dividend yield represents a percentage of the stock price based off of what you paid versus what you received. For instance, if a company pays $1 in annualized dividends and the stock was $20 per share, then the dividend yield would be 5%. It's a very useful valuation metric because you can measure their dividend yield over historical time. So if I notice that a company over the past 5 years has consistently gave somewhere in that 5% range, then that tells me that they're pretty stable. They've been pretty stable. If they gave 5% last year and this year they're giving 4%, I want to know why they're declining. Why is that dividend yield declining? Is it declining because the price of the stock is increasing, but the dividend that they're giving is not? That's a perfect reason for the dividend yield to go down. It doesn't mean that the company is not doing well. The price of the share is increasing, but they're not giving out no more than what they've been giving. Is that a reason not to buy? No, it's not. However, if it's because the company is giving out less dividends each year, if you notice over the last 5 years of historical data, that 5 years ago they gave out 50 cents per share per quarter. Year number 4 years ago they gave out 40 cents. 3 years ago 30, 2 years 20, and now this year's 10%. There's a consistent decline. Something is wrong. It could be that they're using more of their money for growth for one reason or another, but it's not good for an income portfolio because they're constantly decreasing. So when I look at dividend yield, I'm looking for consistency. The key thing to know is that while a higher yield is better, a company's ability to maintain the dividend payout and ideally grow it matters even more. So if they grow it super fast, I'm looking, why did you go from 5% to 17% dividend yield? Only one of two things could happen. Either the price of the stock dropped drastically, or the amount they're giving out increased drastically. Even though they're giving out more, I want to know why. I need to know the why to that. Or is it so that you can keep people from selling their shares because there's something going on? That's a red flag for me. I want consistency. So that's what the dividend yield is. So when you're actually doing your grading scale for dividend yield, look at the last 3 to 5 years. Have they been consistent? Have they grown consecutively each year in what they've given as a dividend? That's a plus. Have they decreased each year consecutively in dividend yield? That's a minus. Could be a minus. Find out why. If the why is the price has increased every year, the stock price has grown every year, and they just haven't given out more dividends than what they've been doing, then that's okay. That's a safe bet. If that's not the case, and the case is that the amount of dividends that they're giving per year has declined every year, then that's a no-go. That's a negative. So that's what we're looking for dividend yield. Let's take a look at payout ratio. Payout ratio is the dividend as a percentage of a company's net income. If a company earns $1 per share in net income, so for every share that they've sold, they've earned $1 towards that share. And let's say they pay out 50 cents per share in dividend, then that's a payout ratio of 50%. So 50 cents is what they pay out. They earn $1 per share in net income. So when you do the actual ratio, the ratio comes out to be 50%. So in general terms, the lower the payout ratio, the more sustainable a dividend should be. If a company is giving out 50% of the income that they've earned, that's a lot. So if a company made $1 billion in profit, in net income, and they're giving out 500 million of that to their shareholders, that's a lot. So there isn't a specific number that you're looking for. You're looking for a keyword here, consistency. Are they continually growing? Are they continually decreasing? Or are they staying at a consistent level? So are they earning the payout ratio at like 30%, 20%? They're paying out 20% of their net income to their shareholders, basically is what that is. So for all the money they made after paying out all their employees, paying all their expenses, taxes, the net income, the percentage of that they're giving back to their shareholders is what's called the payout ratio. If they're paying out 75%, which is unheard of, something has got to be wrong. If they're paying out 50%, maybe this is a one-time deal. But consecutively over the years, I want to see consistency, and I want to see it lower than 50%. Now, if it's 10% or higher, that's pretty good. So that's how I measure or monitor payout ratio. Now, am I looking for a specific number? If it's this exact number, then it's good. No, it's not. Consistency over time. I'm comparing what did you do last year versus this year. If it's a slow increase, last year they gave out 12% as a ratio. This year they're giving out 13%. Okay, that's consistent. It's no major jumps going on. There's nothing that should cause an alarm. If they gave out 12% last year and this year they're giving out 11%, that's still not a major alarm. Now, if they gave out 12% last year and this year they're giving out 2%, I want to know why. Something's happening, or they have plans to do some things, such as research and development or some type of growth mechanism that they're needing more income to do it with. So that's what I look for as far as payout ratio. Now, cash payout ratio. It's the cash dividend payout rate. The cash dividend payout ratio can be a handy metric to use alongside with what we call our earnings payout ratio. Since earnings can vary significantly from cash flows, especially from one quarter to the next. So when we look at a cash payout ratio, it's important to evaluate the sustainability of a company's dividend payments, which is what the cash payout ratio is used for. The cash dividend payout ratio measures the proportion of cash flow a company pays to a common stockholder or shareholder after subtracting preferred dividend payments. It shows what percentage of a company's net income is being paid in the form of cash dividends. So the cash dividend ratio is calculated by taking the amount of cash dividends paid to your common shareholders, as I mentioned, and divided by a company's cash flows minus any capital expenditures and preferred dividend payments. So the bare bone basics, how we're going to sum this up. It is the amount of dividends that are paid to us divided by a company's cash flow minus their expenses and the people they pay out before they pay everybody else. Think of it that way. And so there's a formula to it. You don't really have to pay attention much to the formula because it's going to be given to you. But what are we looking for here? What are we looking for when we're using the cash dividend payout? It's a strong measure of a company's likelihood to sustain its current level of dividends. That's all that is. I want to know if you're paying me this much in dividends per share now, what is the likelihood that you're going to continue doing this in the future? How are you using your cash flow? Basically is what this tells me. So what am I looking for when I look at their numbers? I want to see, let's see, you guessed it, consistency. If you've consistently had a ratio of, let's say, 8 to 10%, that's what the company has consistently been at. And I like everything else that they're doing as far as their metrics, then there's a high likelihood that they're going to continue to pay that dividend at that rate. So when we look at cash payout ratio, we're looking at the consistency over time. And if it's staying within a certain range, let's say within plus or minus 5% over the past 5 years of what they've been doing, that tell me that this company is stable. All of this information, once again, you can find it right on your online broker's page, or you can go to CNBC or Yahoo Finance. Every bit of this is available to you. You don't have to calculate the ratios. They're already there for you. So the main thing is just pulling them up for each stock that you're actually looking into. So let's take a look at the next one here. Total return. The overall performance of a stock is the combination of dividends and gains or losses from a share price change. For example, if a stock rises by 6% this year and that same stock pays out 3% dividend yield, then the total return is 9%. So it's the total that you gain from the stock price going up plus the dividend you received is your total return. So that's the total value of your return, rather, because the actual gain in the stock price, you don't get that until you sell the stock. Dividend income, or the dividend, you get immediately once they actually on that payout date for the dividend. So if you combine the two, then that's your total return. Once again, I'm looking at my total return as consistency. If I'm consistently seeing a 3% dividend yield and I'm seeing a rise in the stock price over the years, that's excellent. That's A1, because you're not only getting income from your dividend, you're getting capital gain income from its growth. That's two pluses. You're going to mark that double time if you can find stocks that are doing that. So as far as whether it's good or not, if over time I notice that the stock price is consistently going down, then the stock is not rising, it's declining. If it's consistent, meaning the price of Coca-Cola is always in a range of between $45 to $55 or something like that. No matter what year you look, it's always going to fall between that range. Remember the range we talked about last week about the 52-week high-low? That's where I pull my ranges from. That will tell me whether or not the total return is good. If I'm seeing a consistent decline in the stock price, then my total return is going to decline. If it gets to a point where the stock price has lowered so much, but the stock price is declining at 3% and my dividend yield is 3%, then I'm not gaining anything. It's neutral. I didn't lose anything. I didn't gain anything. If the stock price is declining at 7% this year, then I have just lost 4%. That's how we want to look at total return. All right, EPS, earnings per share. In general, a company must earn more than its dividend in order to sustain it. And the metric normalizes its results to the per share value. So the best dividend stocks are companies that have shown the ability to regularly grow earnings per share over time. Companies that consistently grow earnings per share often have strong competitive advantage. So they have better opportunities to gain more income from the market than other companies that are offering the same or similar services or products. So the result is a company that can keep paying its dividend and potentially increase it. So if the earnings per share, so the total earnings that they've made per share, so if we divide their share by their total earnings, and we'll get the number there, but better yet, they're going to give it to you. So let's say my earnings per share is, per share, they're earning $1.50. Now keep in mind, most companies are going to be in the millions as it pertains to how many shares they have out there. Multi-millions. So if each share, multi-millions of shares, is earning at least $1.75 a share, and the next year they're earning $2 per share. The next year it's $2.10 per share. As long as you're seeing growth, that means they're doing something good with their money. The money that they're bringing in, that you have given to them to help grow that company, if the earnings per share is consistently growing, even at a little bit, that is a good sign. If the earnings per share is consistently going down, that is a bad sign. If you see that, okay, well, in year five, it went up, year 4, it went up, Year 3, it went down. Year 2, it went up. Year 1, it went down. That looks more like the signs of growing pains. But if it's consistent downward trend, consistently, they're not earning as much as they used to, then that tells me they've lost their competitive advantage, or there's some things, inner workings that are happening within the company to where they're not earning as much as they used to. Red alert for me. So with EPS, we're looking for, once again, consistency. Over the course of the last 5 years, 5 years is my normal target. If a company hasn't been in business or been on the public market for at least 5 years, I tend not to use them for dividends. You need to have been given dividends for at least 5 years before I will actually buy you. That's another golden nugget. So EPS, we want to see consistency, but we want to see a consistent growth, even if it's by 1 cent growth. Last one here, P&E ratio. So price to earning ratio divides a company's share price, so the cost of the share, into the earnings per share. With P/E ratio, it's a valuation metric that can be used along with the dividend yield to determine if a dividend stock is fairly valued. And so that's what we're doing with the P/E ratio. I don't spend a lot of time looking at the P/E ratio as far as numbers. But to put it another way, the market's valuing the company at 10 times what it earned over the past year. That's pretty high. So I'm looking to see if this measuring stick can be used to gauge if an investment's valuation is appropriate. And when we talk about a valuation, that's the value of what a stock is known to have. So the value of a company. So if a company says they're worth $500 million, but their P/E ratio is not good, then it's possible that they're being overvaluated. So that's something else we want to look at over time. I want to see consistency. If they're consistently growing, then that's a good thing. And that is the list of the 6 key metrics. Now, we want to take time to show you a little tool. It's very easy, very simple to use, because this may be a little daunting for some to actually go and look up this information. Do you need to look it up? Yes. Do you have to figure out what it is? No. One of the key things you've heard me mention throughout this particular slide here is consistency. Consistency or consistent slow growth. You can glance at a stock by going and pulling it up on your broker, going to their financials, and you can glance and see all of these ratios and all of these numbers and plug them in a simple spreadsheet and say, yes, okay, well, what were the numbers? Were they good? Yes or no? 1 for good and 0 for no. And have it sum it up and give you a grade at the end. And if the grade is 5, then I'm going to go buy. If the grade is 2, I'm not going to go buy it. But if I already have it, I'm going to hold it and watch out for it. So there are simple methods that we can use. So let's take a look. One moment here. What we have here is a simple little spreadsheet. We're going to target our focus on one area here. And let's say I have a stock. Let's type in the name and let's say Coca-Cola. That's our same company from last week. And basically what I'll do is I'll go take a look at the dividend yield for Coca-Cola over time. Our time is 5 years. If I notice consistency, I'm going to give it a rating of 1. 1 meaning good, 0 meaning bad. And just do the drop down, use my drop down, and I'll give it a 1. I'll look at the payout ratio. And based off of what we've discussed as far as payout ratio is concerned, I'll make a determination. Is it good or is it bad for the payout ratio? And what we discussed was we want our payout ratio to be kind of low. So anything over 50% is outrageous. So I definitely want it lower than 50%, but probably higher than 5, 10%. If it falls within that range, and we know that if the company is given a higher payout ratio, the reason for it, or a lower payout ratio for this particular year, or a particular year within the 5 years, then that's okay. We're looking for consistency, and we're looking for knowing the why on this one. So if it is good, we'll go ahead and give it a 1. But let's say it's not. We'll give it a 0. The cash payout ratio. Once you pull that up and actually see what the cash payout ratio is, once again, based off of what we discussed in the prior video, we can assign it a value of 1 for good or 0 for bad. Now, do you have to be specific when doing these? No. This is at a glance taking a look. You're not trying to become a MBA finance, Harvard finance student. We're looking for simplicity. That's the whole purpose of streamlining, finding simple methods that we could do very quickly, very easily to move forward towards finding what we're looking for. So total return, if we found consistency there, it's the total return has either continued to stay where we are or to grow further, then we'll give it a 1, as in good. Earnings per share, we want to see consistent growth, even if it's a little bit. If it starts going the opposite direction, that's a sign. So let's say they're starting to decline just a little bit. We'll give them a 0. P&E ratio. If based off of what we discussed, what a P&E ratio is, the valuation of the company. If we find that it's consistent, then we can go ahead and give them the 1. It'll give us a total score. Total score is 4, as we see in the cell. And then based off of our grading scale, a level 4 says buy, but with caution. Let's say we were looking at the company and earnings per share is still being consistent. Level of 5, strong buy based off of our chart. Let's say the dividend yield was the only thing we found good. Everything else was a 0. The total return is going backwards, not forward. EPS going backwards, not forward. The P&E ratio, we're not quite sure, but let's say we're giving them a 1. Based off of our chart, their level is a 2, and you should not be buying them. If you already have them, you can hold or hold with caution. For newbies or people just getting started, anything with a 3 or below, I'm not buying. If I have them in my portfolio, even at a 2, I would go ahead and sell. And the reason why is because I mentioned that I only research my dividend stocks that I actually have in my portfolio every 90 days because they're consistent. And so all I'm doing is looking to make sure that they're still consistent, unless I hear about something in the news. If I hear something in the news that pertains to the market that my companies are a part of, I might go ahead and do a little research. That might alert me a little bit. So, but outside of that, we're looking for consistency, because only a company that's consistently earning a profit, a good profit, is going to turn around and give funding or money to their shareholders. So with that being said, if I'm going to hold with caution, I might as well go sell and find a company that's either at a 4 or higher. That's buy with caution or strong buy. You could say that, hey, I only want things that fall under strong buy just to be safe or safer. That's fine as well. But at least this gives you some kind of gauge to work with. It's a simple method to use. Is it the best and the greatest method? There are other options out there. But like I said, we're not trying to get an MBA from Harvard in finance right now. We're looking for simplicity and something simple to be able to use. Now, there are other things you could do with this. With the companies that you have, you could create a spreadsheet that you actually put in all of the values so that you can watch it yourself if you want to over the years. I don't do that simply because the online broker already has all that information for me. So this is a simple key metric grading scale is what I call it, just to kind of have a little scale that you can use that will tell you whether something is a decent stock to buy or not. You will have to look up this information, though, by either going to some type of finance site or using your online broker to pull this information. And then, like I said, just look over the course of 5 years and you can easily see either it went up or it went down. If it's going down and it's not consistent, 0. If it's been consistent over time, give a little, take a little, okay, give them a 1. And then based off of that, you can have your simple tool that tells you whether or not this company is decent to buy. So that's a little tool that I use right here. And I'm going to make this available to you to download. Once I actually have it up on the website to download, you will see an actual comment under the video. So in the comments under the video, I will post a link and you guys can download it and use it as you will. It was a quick demo of a little tool that you can use. If you want to get more deeper in depth with these, there are tons of videos on YouTube going over each one of these key metrics. Just wanted to try to keep it as simple as possible because, like I said, we're not trying to master any of these. We're just trying to find some dividend income stocks that we can hold on to and feel safe about it. So these are the tools that I use when grading stocks. Now, I wanted to share with you a portfolio that I found online that was pretty good and show you how this whole methodology of creating income from dividend works. So we have 12 stocks. That's it. And over the course of a year, for each month and each week, you'll notice that I have the name of different companies. And basically the way it's set up is that, let's take a look at January, for example. The first week of January, Walmart pays out dividends. The second week of January, Altria Group pays out dividends. The third week of January, WP Carey pays out dividends. The fourth week, Cisco. And you'll notice that by the fourth month, so when we come back to April, you have January, February, March, April, here we go. Walmart, Altria Group, WP Carey, and Cisco are paying out again. That's because they pay out quarterly. So when you're masterminding your portfolio, if you want to set this up to where you're getting income every week flowing to you, try to space them out to where they're not paying at the same, all your companies aren't paying at the same time. Now, is there a problem with having everyone pay out at the same time? Not at all. But if you're trying to create an income that you can kind of count on coming during certain time frames, you may say, I just want everybody that can pay me in the month of January and everyone that pays out in the month of February, and make your list that way. But at least by having a strategy, a portfolio strategy, you can then start to build your income in a way that, let's say I want to build up my portfolio to the point that it can pay my car note every month. Well, my car note's due every single month, not every quarter. So I need to find some stocks that are paying out during specific time frames so that can cover my car note, if that's the purpose of what I'm trying to get to. So you can come up with ideas and ways to plan out your portfolio strategy. You may want to be like this one is, where you're getting a check every week, but it takes time to build it up to where you're getting that much income coming to you. But it's good to start early in knowing, what is the purpose of my portfolio? How do I want to get paid from my portfolio? By knowing that up front, you can design and pick stocks based off of your strategy. In this case, this person wanted to get paid every week. They wanted income flowing every week. For me, this is great. Why? I have 8 streams of income. Some of those streams of income may need funding to be able to reinvest or do some other things that I may want to do in them. And I might need to pull some income to do that. And instead of me selling my stocks, I might say, hey, well, I've built up my Walmart, Altria Group, and Cisco stocks to where they're paying out enough to give me across all my stocks for that payout for the month of January. They're giving me $1,000. I need 500 of that to go and do XYZ, to invest in something else or something. So there's plenty of ways that you can use your assets. And in this case, your dividend portfolio is an asset that you can pull from to do other things. Now, in the beginning, I do not recommend pulling from them because you want to build them up. And we're going to talk about how to grow your portfolio in just a second here. So this is a good start to give you an idea. I wanted you to kind of visualize how you can map out your income from dividend stocks. So you're not just going, okay, well, let me go find the highest dividend yield. Nope. What if you're trying to map out, build up a portfolio that over the course of time you can give to your children? And this portfolio is going to pay their mortgage, so they will never have to pay a mortgage the day of their life. Perfect example. So you may be building this for your generation and not just for you. If that's the case, then that's a part of your strategy and how you're building it. If it's for the purpose of just having it as an asset so that you have something to pull from, which is kind of what I'm using it for right now, then how I structure it may be different than how someone who's structuring their portfolio for generational purposes may set it up. So this just kind of gives you an idea, and you can make your own chart to map out, okay, how often are these companies paying? Well, if it pays every month, then you're going to have some companies that are on this list for every single month, which I do have some of those blended into the different companies that I've bought into. If you are building for a monthly income, then you definitely want some monthly stocks in there that are paying monthly dividend paying stocks. And you want to shift the different types of companies that you buy into based off of when they pay out. And once again, you can find that right on your online broker. When you pull up the ticker symbol, it's going to show payout date, ex-dividend date. Ex-dividend date is the date that they check to see how many shares you have. Payout date is the date that they're going to pay you the dividends per share that you have. So this is a good start. And actually, these are some pretty good companies on here as far as this list. So as a challenge, check out these companies. Go pull them up. Do a little research. Use the tool that I gave you to see how these companies fare out. And this is from someone that built this back in 2017, I believe. So some of these may still be great. Some may have shifted and changed. I can tell you that I do own some of these, one of them being Altria Group. I've had them as a dividend stock for over 10, maybe 12 years. So they're consistent as far as paying out stocks. Other stocks I have, Cisco I do own. I have owned and sold and bought and sold and bought and sold Cisco. Lockheed Martin, that is a research company. Well, they do research, but they mainly deal with planes, building and designing planes. So they're another one that I have owned. I don't own them anymore right now. I sold all of my Lockheed Martin. Johnson & Johnson is from the Dow 30. I mentioned about the Dow 30 last week in our training. So you can go through these and take a look. Some of them you might like just because it's something you know. Everybody knows Walmart. So that may be a reason that, hey, they give stocks. I know them. I use my tool. Everything looks good. I'm going to buy. So that might be a reason. So just wanted to show you a dividend portfolio strategy. All right. Now, how to build your income. Patience. I cannot stress the word patience. It can be hard and it can be a little deceiving when you first start out and all you're seeing in your dividend income is $1, $2, 50 cents. Going, I'm doing all of this work and that's all I got. But over time, that builds up. So the more shares you get, so if you're getting $1 per share and all you have is one share, that's still $1 that you didn't have to work for. That's how I look at it. That's free money. But over time, if I got 5 shares, that's $5. If I got 10 shares, that's $10. If I have 100 shares, that's $100. Okay, we're starting to get the point here. The point is to build your portfolio. So how can you do that? Well, of course, you can always buy more of what you have. Another option is to do what's called dividend reinvestment. And what this is instead of letting the dividends come to you in the form of a check, let your online broker automatically reinvest in that same stock for you. Reason why? No commissions. Well, based off of our training, you should be using a broker that doesn't charge commissions anyway. But more importantly, you can buy fractional shares. So if you've received $5 and the stock price is $20, they're going to purchase $5 worth of that stock. So you're going to get 25% of that stock. If you own 5 shares, now you own 5.25 shares. How does that help? Over time, that's going to turn into a whole share. And that's one more share that you did not buy that you now own to help build your portfolio. And it's convenient. There's no work on your end. It does all the work for you. I mentioned earlier, I'm looking for the most hassle-free, work-free method to increase income. Dividend reinvestments does that for you because it's going to compound. You know, I love the word compounding. Love that. You want to balance your portfolio as far as the dividend yield is concerned. My dividend yield for the companies I have range between 4 to on average 10%. I have a few that go over 10%, and that's me being risky. Why? Because if a company is paying you 13% in dividend yield, something's happening. Maybe they're paying a higher dividend yield to keep me from selling my stocks. If so, I might buy them just cause, but I'm keeping an eye out on them just to make sure that the stock price doesn't drop so low that all of the dividends that I'm earning, I'm losing because the stock price is dropping. So anything over 10, I'm cautious of, but I will play around a little bit. So for a balanced portfolio, you want anything between 4 to 10. I like 7%. I like to stay in the middle of that, trying to get the most that I can. Most of my stocks, I pay between the cost of $10 to $20. Why? I can buy more of them at one time than I can of $1,000 share or something. And last but not least, diversification. The reason why you want to diversify your portfolio, and that means buying companies from different segments. You don't want all technology. You don't want all pharmaceuticals. You don't want all retail. Because what if, let's say real estate, you have all real estate types of REITs or REITs, and the real estate market crashes. That's your whole portfolio. There's nothing to balance that out and leverage what you have. So diversification, I like to buy from at least 4 to 5 different markets so that if one market is moving slow, the others are doing well, that's great. If one market plummets, it's not going to plummet my entire portfolio. And that's what's helped me to manage and maintain a profitable dividend portfolio. All right, so we're going to wrap it up with something to think about. And we're going a little lengthy here tonight, but we're learning, so that's good. Something to think about. What would happen to your dividend income if you increase the number of shares you own, so your number of shares by 1 to 3 shares each month, consistently, over the course of time? If you could very easily do that if you purchase stocks in the range of $10 to $20, as I mentioned, that's what I like. Now, does that mean I'll only purchase at that price? No. Coca-Cola is like $50. I might get some of them, but their dividend yield is always around 3%, 3-4%, depending on which of the companies you're buying into that they have. So that's something to keep an eye out. If you're buying at the lower range, you can consistently increase it and improve it. And I have a quick tip I'm going to give you later on when we advance a little more of how you can get some of those more pricier stocks by using the money you're earning from your lower stocks. That's another something to think about. Increase quarterly income by compounding. How do we compound? Dividend reinvestments. Drips create additional partial shares. So think about, how can you increase your portfolio with dividend income stocks? What can you do on a consistent basis? If all you can do is buy one $10 stock, can't talk tonight, one $10 stock, then that's better than nothing. It will still grow because compounding. That one share that you add every month is going to be a total of 3 shares every quarter when that company comes on the ex-dividend date to see how many you have. That's compounding, because you're going to get partial shares added to go along with what you're adding. And that is how I build up my dividend portfolio. I made a commitment that every month I was going to buy something, and I was strategic about what I was going to buy. When I mean strategic, that portfolio I just showed you, I knew what I was trying to set up and create. And if you know that in the beginning and you set your plan, I want to create income that I'm going to get a check every month for X amount of dollars via income, then you have a goal to build up to. So my challenge to you is to, for the next 90 days going into 2020, well, starting in 2020, set your strategy for your portfolio, what you want to accomplish, what is your goal. Now, mind you, make your goal something reachable, something reasonable. If your goal is to create $10,000 in dividend income, then you're going to have hundreds of thousands of dollars to work with to get there. But it's nothing wrong with saying, hey, in the next 90 days, I want to create my portfolio to where it's bringing me a minimum of $250 annually or something like that. Set your goal. Make your goal within reasonable reach that you know you can do. And then over the course of the next 90 days, decide what stocks I'm going to buy and build them up. And over time, if you're consistent with that, you're going to do what I did one day and look up and go, wow, I'm getting a check that's enough to pay off my car note every month. Or I'm getting a check enough to pay off my mortgage every month. That's another stream of income. Something to think about. All right, guys, it's been great. We went over a little bit tonight, but I'm enjoying myself and I don't mind sharing. So if you have any questions, as usual, feel free to send me an email. You can send it to info@streamlineig.com, or you can meet me in the Facebook private group. All are welcome to join. You can join Streamline IG there. And also, don't forget, I'm going to post the tool under the comment section once it's up. Have a great evening.